Okay, so I'm recording now, and hopefully the microphone I bought will work. It's my last gasp to stay in this classroom. Otherwise, they're going to move me over to the UC. All right. So what I wanted to check with is last week we left with a couple practice problems. I want to move to the in-class work. So I just wanted to know, after you guys read these, do you feel like you have any questions? I don't normally go over practice questions unless there's time, but I want to make sure if you look at them, if you have some questions, that I'll be happy to help. And of course, the answers are always available. But take a minute to look them over, and then we'll go from there. And for those of you who are online, the group problem is in our modules. So if you open up and you go to assignments, you can find the group problem. I lied. I'm still in the wrong course. No, we're fall 2024. This is right. Okay. Where are my group problems? No. It's so embarrassing. Just have too many classes, one after another. Thank you. So if you go into the assignments, it'll be down here under group problems and the chapter 17 problem. And it's due September 12th at 2 p.m. But we're going to work on it here in class. So I'm going to stop recording, and then I'm going to pick up recording when I start the notes in. So at 3 o'clock. Okay, so you'll have 25 minutes to work on the group problem that I handed out together. We covered everything that you need. And if you have any questions or need another copy of it, let me know. Okay. Zoom recording. So hello, Sonia, and others that are watching. What we did was we went through the group problem for chapter 7, and you will have to do it and turn it in online before our next class. Now, the last part of the class is, or excuse me, of chapter 7 is what happens when there's an inventory error. And this is kind of why I extended that on Sunday, because I did not cover it, even though it's part of the homework. And so there are kinds of two types of errors, right? You have the inventory is understated or the inventory is overstated. And so what happens when your inventory is understated? Pretty obvious, right? Understated. But when we think about this now, we just have to think about the flows for inventory, right? From inventory, we flow to cost of goods sold for the items that are sold. For what's left, it becomes the, let's do it this way, is the ending inventory. And then on your cost of goods sold, it flows through to net income and also gross profit, right? In case they ask about that. So if I understate my inventory, Then I'm gonna overstate my cost of goods sold. I didn't move there. I'm gonna overstate my cost of goods sold, which means my net income is gonna be understated. If my net income is understated, my retained earnings is understated. Now, working capital, what's working capital? Working capital is basically your current assets, either in a ratio to your current liabilities or your current assets divided by your liabilities. So if we understate inventory, we're essentially taking things out of the numerator. And so we're going to end up understating working capital, and we're also going to understate the current ratio. Now there's another ratio that's kind of like the current ratio, which is called the quick ratio, and they drop the inventory. So if you ever talk to finance people, they'll generally look at kind of what you can turn into cash really fast. And they sort of feel like accounting in terms of the inventory might not always give you the best ability of what you can turn that into cash for, even though it's supposed to be. So they use what's called the quick ratio sometimes instead of a current ratio. So that would exclude inventory and there would be no effect there. So for the most part, this is sort of opposite, right? Overstated. Retained earnings is overstated. When you reverse this, overstated and overstated. Cost of goods sold would be overstated. No, I'm sorry, understated. And then overstated. Okay, a little note, keep in mind that a true inventory error will reverse in the next year, causing the opposite effect, but won't carry beyond the next year. And then you go, well, unless fraud. My goodness. They changed what you should put commas in front of them, what you shouldn't put commas in front, and I want to fight the English people. It used to be that you put a comma in front of but. Now you put a comma in front of and. Yeah. It's because and is like often a separate clause, like you're attaching something that isn't completely the same, which I thought was but, and you do it when you pause, but now they changed it. What's that? Well, but you don't do anymore. So yes, once you have to start writing, I highly recommend subscribing to like a Grammarly or something similar just to check it over. Word does a decent job of doing it, but it's still not great. But Grammarly, I really like, and it helps me. You can tell what kind of writing you're doing. I think it's like $85 a year, which is still not terrible. You know, you just got to think how much you use it. Like in the past 2 or 3 years. Yeah, there's still some cases where you use the comma in front of but I don't know when. All right, so keep that in mind. If it's a true error, it's going to reverse and be done with the next year. But if it's fraud, then that error will keep happening, and it's not really an error anymore. But a true error, because if you overcounted in 1 year, that'll flush out through the cost of goods sold next year because those won't be there. So you'll have all the opposite effects. Now this is when you're using purchases and inventory method. And so what is the understated purchases and ending inventory? So inventory is understated. Retained earnings, there is no effect because you didn't record the purchase here, right? So in this case, accounts payable would be understated. Your working capital would have no effect. And your current ratio would be overstated. Your purchases would be understated. Your cost of goods sold would have no effect. Your net income would have no effect. And your ending inventory would be understated. Okay, and in this case, now we're overstating purchases and we're overstating the ending inventory as well. So this would be overstated. Retained earnings would have no effect. Your accounts payable would be overstated. Your working capital had no effect. And your current ratio would be overstated. And your purchases, overstated. Honestly. No effect. No effect. And overstated. Now I wouldn't go through and memorize these. I would just keep this chart next to you when you're doing the test, right? I mean, I don't even commit them to memory. I can think them through, but if you've got a question, you've got your answers right there. There's no point in trying to memorize this. I always think it's a bad idea to memorize accounting stuff. Some stuff you have to memorize, but once you start to try to memorize it, it makes it even different. And as you can see, half time, I don't know what class I'm in, right? Any questions there before I go over some examples? Okay. All right, so risers reported total assets of 2.4 million and net income of 320,000 for the current year. Riser determined that inventory was overstated by 24,000 at the beginning of the year. It was not corrected. What is the corrected amount for the total assets and net income for the year? So we look at this and what we say is, okay, does total assets change if inventory was wrong at the beginning of the year? No, we wouldn't expect it to be, right? Because we would expect them to do the proper count at the end of the year this time, and that mistake will flow through to cost of goods sold. So we end up with a cost of goods sold that's too high, and then a net income or gross profit that is going to be lower. So in this case, inventory was overstated at the beginning of the year. So this one we're gonna, I think I said that backwards. Okay, so now net income is understated because cost of goods sold is overstated. So 320,000 plus 24,000 equals 344,000. $2.4 million, so the answer is B. Hudson's a calendar year corporation. Its financial statements for the year 2026 and 2025 contained errors. So 2026, 9,000 overstated, 6,000 understated. Oh, now we're throwing depreciation in there. 24,000 overstated and 18,000 overstated. Assuming that the proper correcting entries were made at December 31st, 2025, by how much will 2026 income for taxes be overstated or understated? So they put the correcting entries in. And so we have, okay, what is your ending inventory related to income? So ending inventory is overstated by 9,000. So cost of goods sold is understated by 9,000. And net income is overstated by 9,000. And then now we look at the second part. And so depreciation expense, 6,000 understated. So net income is overstated by 6,000. Since both are overstated, you have 9,000 plus the 6,000, and that equals 15,000 overstated. And that answer is D. Any questions with those first two? Okay, example 3. Charlie has some turnover in its parts inventory area. As a result, some of its inventory counting errors have been made in taking the physical ending inventory in the last 2 fiscal years. Its financial statements for 2026 and 2025 contained errors as follows. Charlie had a 9/30 fiscal year end. What? Assume that no correcting entries were made and no additional errors occurred in fiscal 2027. Ignoring income taxes, by how much would income be overstated or understated at 9/30/2026? Okay, so we had 16,000 overstated in 2025, no correcting entries. And then we have 2,000 understated in 2026. No correcting entries. So we now have to think about, okay, if I'm overstated in a prior year, that means that 16,000 is going to cause us to be understated in 2026. And 2,000 is already understated. So the answer would be 18,000. And that's 16,000 plus the 2,000. Have a couple practice questions for you. So you guys can take a look at those. Give you guys about 6 minutes and then I'll come back after all three. This is not a quiz. These are just for you to practice. So feel free to talk to your neighbors and work it through. Unless they got you on the group project and then you know better, right? You're a little early. Similar mental issues. And you should see my notes because I only use pens. Brutal. So much smarter to use pencil, but I just can't do it. Nice. Give you another minute. And then we'll walk through them. And then you'll be done with chapter 7. Anybody still working on it? Want another minute? Or are we good to go? Sure. Okay. All right. So the first answer is going to be overstatement, understatement, and no effect. Okay. Now, if you ever get nervous about it, just think about throwing something in. So if my beginning inventory was 100,000, but it was supposed to be 90,000, then when it flows to cost of goods sold, when I count my ending inventory, it should be correct. And so what happens is that my cost of goods sold is overstated. Now, they didn't give us numbers here, but if you're ever struggling, you can just put it in numerical concept and see. And then, of course, your net income would be under, and here it would be correct, right? And then they asked about assets, and your assets should be accurate because of the count at the end of the year. Practice number 2. Answer is also B, understate next income. And that's pretty straightforward. What is the impact on net income of including goods in transit? So by including goods in transit, FOB shipping point, which you should not have included, you would overstate your inventory. Excuse me, yeah, you would overstate your inventory, understate your cost of goods sold. So then this one's understate net income. Oh, but not in ending inventory. Okay. So they just including goods in transit, FOB shipping point, and purchases. That's so confusing. So this one's like one that we didn't do. It's like, I didn't overstate inventory, but I overstated purchases. Since you overstated purchases, it would flow through and it would understate your net income. And then practice 3, failure to record a purchase on merchandise account, even though the goods are properly included in the physical inventory, results in an understatement of liabilities and an overstatement of owner's equity. Any questions? You all are free to go, and I will see you on Thursday. Thank you, Sonia. Yeah, that'll be a part of the type of questions you would see on an exam.